Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree, Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. The market has significantly declined. Suppose you're completely new to investing, or even if you've been doing it for a while, either case you might be wondering what to do. You might ask yourself, should I immediately sell the stocks? Should I purchase more? Should I try cryptocurrency investment? Should I purchase gold? What should I do exactly? People are selling their investments because they're worried and panicking. Some people turn to watch the news just to understand what's happening. However, by the time they've finished, they've probably ran into terms like quantitative easing yields and negative interest rates, and it's difficult to make sense of all these complexities. In this video, we'll describe what's really going on and why it's happening. The problem is that individuals are currently experiencing this, not necessarily what they're seeing, but rather what they're feeling internally. Let me explain. For example, I'll use a Robinhood portfolio here in order to demonstrate what's happening. So let's take a look. As you can see, last week, according to our portfolio here, it was worth $240,000, and now 7.94% was lost, turning to $188,150. So there's a difference of $16,237, and that's $16,000 in a week is a lot. Everyone is panic selling their stocks and getting rid of them. We lost 8% in this past week alone. What does it mean? Is 8% that bad? For example, 8% indicates that if I did this for just 1 week, we would have lost the equivalent, and I would have reversed 1 year's worth of progress. Thus, if you've invested for a whole year and saw your money rise 365 days in a row, you would have lost exactly 8% of your investment in only 1 week. Banks like Goldman Sachs predict that we'll lose another 7% this year alone, which would equal nearly another year's worth of progress that's predicted to be gone in 2020. That suggests this could be the worst week for stocks since the 2008 financial crisis. But guess what? We should be happier for having less money. For example, I have $180,000 in my Robinhood account, and I'm way more happier with it than when I had $200,000. That's weird, right? Maybe you're wondering why. It's because even if having $200,000 is wonderful and makes me feel like I have a larger net worth, it's not when fortunes and passive income streams are created. Instead, they emerge during periods like these when everyone is panicking and the economy is falling. This investment strategy is currently so exciting. Let's go back to 2015. Imagine we're still in 2015 right now. You don't have any experience in stock market declines before, so that was your first time. In the course of 7 months, your financial situation decreased from having a $132,000 income to just having a $114,000 income, or around $18,000. So when you're earning around $40,000 per year, this is a loss of 50% of your yearly income in just 7 months. Then you might think that you just want to save your money instead of risking so much of it. So fortunately, you continued buying more and more bit by bit. And after taking a break, you realized that the lesson you'd learned from the entire experience was that it was sometimes appropriate to take a break and refrain from making drastic choices out of fear. So then fortunately, the market recovered. However, 2 years later in 2018, there was another test, and this time it was worse. For instance, you were worth approximately $107,300 at the end of November 2018, but in only 3 short weeks, that value dropped to $154,000, a loss of nearly $20,000 in value. You might have gone crazy at that time, and probably many people would have gone crazy if they had lost that much money in 3 short weeks as well. But if you had lost money before, maybe that was okay. Of course, you continued to buy more at a time when many people were predicting the end of the world, but it continued to rise and recover, and you continued to buy more and more. Maybe if I were holding on to Tesla stock and I had purchased it at $900, I suppose I'd be very eager to sell it if it fell below $700. I'm just trying to show that it becomes much harder to hold on to growth stocks when you see a year's worth of progress vanish in just a week. In an ideal world, you would never sell your growth stocks because you are an investor, not a predictor. I can hold on because it's going to continue paying me passive income regardless of what the stock price actually is, which is an amazing moment. Unlike a dividend investor who's really happy when the prices go lower because my income will stay largely the same assuming the company is still profitable and it doesn't cut its dividend. The majority of people don't realize this, but when you buy stocks, you're actually buying shares of a company. This is difficult to understand because you're not actually looking at a physical stock. Instead, you're looking at something on your mobile phone. Additionally, buying stocks doesn't make your phone feel heavier physically like buying real estate does because you can hold it in your hands. So always keep in mind to consider stocks as if you were purchasing pieces of a company. Imagine your home losing $10,000 in value tomorrow. Would you just sell it out of panic? Of course you wouldn't do that. You'd just keep living there. But consider if your home were a stock. Selling it would be as simple as a swipe, and before you knew it, you were standing outside. So what precisely is happening, and why is it all happening? I believe Warren Buffett is the smartest guy in the room right now. He conducted a 2-hour-long sit-down with CNBC. This was the main lesson I learned from watching the interview.
I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now, 20 or 30 years from now. America's business and probably over the world will be far better than it is now.
See, not even the greatest billionaire can predict what will happen in the near future. Because if he did, he'd sell all of his stocks, wait for the market, and then just reinvest. But he doesn't know it because no one else can. If measures like quantitative easing, share repurchases, and negative interest rates are making you nervous because you know they're propping the economy, then yes, those measures are probably helpful. However, nobody, not even Warren Buffett, knows what those measures will mean for the economy in the long run. All we know is that the government is currently working to boost the economy by encouraging consumers to make more purchases by lowering the cost of borrowing money. The most crucial element of what Warren Buffett was trying to say is that they want us to go out and buy automobiles, houses, and whatever else we need to borrow money for. And another is just to adjust your spending to your income rather than the other way around. Don't spend more than you make and resist the urge to pursue investments with bigger yields as interest rates may fall even further. These are the two fundamental financial minimalism and frugal core principles that you should remember. It'll all be tempting to pursue cryptocurrency because that is where all the activity is and where you want to invest. But doing so could actually harm you. The world's smartest guy says, I don't know. Just keep buying stocks in the next 20 years and you'll do all right. So if you sold your stocks, here are the things you can do. Keep this in mind if you decide to sell your stocks out of fear of losing money. The stock market's highest gains normally occur during a 10-day window period. And if you miss those 10 days, specifically 6 of those biggest 10 days, your returns might be reduced by as much as 50%. Even worse, those higher returns frequently occur within 2 weeks following the worst 10 days. However, what this means is that we might see a terrible 10-day stretch followed by the largest recovery we've ever witnessed 2 weeks later. Simply avoid it. It won't be worth it. And that's it. You can share your thoughts in the comment section below. Thank you for watching.
So that's it for today. I hope you learned something from today's video. And to get updated with the next videos, don't forget to hit the notification bell. See you next time.